Hello and welcome. Today we're joined by Zac Phillips, who is a consultant in the oil and gas industry. In fact, today we're going to be talking about helium, hydrogen, and gas specifically, and also kind of talk about a note he's done recently on Georgina Energy. Zac, how are you?
Very well, thank you very much. Nice to be here with you, Matthew.
Pleasure, and thank you for making time for us. Well, we better get a bit of background on you. What gives you the kind of credibility to have written this note? What have you done in the past?
Well, I guess a lot of my background is technical. I'm a chemical engineer and petroleum engineer by training, and I've been in and around the oil and gas space for about the last 20 odd years, probably more years than I care to remember.
I mean, such as where have you worked before?
The likes of BP, Chevron, and I've also obviously crossed over onto the financial side, being the CFO for Dubai World's oil and gas business in the early 2000s.
Right. Okay. So, been around the block, know what you're talking about. So, I think that's important to establish for people who may be listening in on this one. So, Georgina Energy. Couple of Aussies with an asset in Australia, or a couple of assets in Australia listed recently on AIM. Can we sort of maybe have a little chat about the assets themselves, and in terms of the two assets themselves, Mount Winter and Hussar? What can you tell us?
Well, I mean, they are previous discoveries, and I want to use the word discovery in its pejorative sense. They're exceedingly large accumulations as defined on seismic. They have had penetrations in the target horizons, and they have recorded helium. But there's been no flow testing. There's been very little further work. I think when the exploration program was undertaken, they were targeting either oil or gas, and when they failed to find meaningful liquids in the shows, I think they overweighted the muds and killed the wells. So, you know, what you've effectively got here is two very early stage appraisal discoveries that, through the stint of having existing well stock, can actually be tested at a lower, theoretically in a lower cost environment. But again, you know, there's a lot of study that needs to be done as to whether the existing wells can be used.
Right. Okay. Well, one, technically, they're not re-entering. Are they sort of basically twinning? What are they attempting to do?
I think at the moment they're studying the feasibility of being able to re-enter.
Okay.
They're good quality wells from what we've seen, and we're not sure what the status of the cement plug and the plugging and abandonment has been. So I think that's going to be part of the desktop study and the field review that happens between now, having raised the money to do it, and when they actually pull the trigger on what they are going to do.
Right. Let's try and understand the data that's available. I think you used the phrase that previous exploration has proven the presence of helium, hydrogen, and natural gas. But in terms of the amount of work done there, there's been no sort of flow tests, etc. So, what is the extent of it? It's early stage exploration, but what does that mean?
Well, I mean, it's early stage. In essence, the exploration stage would probably be 90% complete. They've identified what they think is an accumulation of helium, hydrogen, and natural gas. But what's now needed is a targeted program to re-identify those particular components, quantify those components, and then assess whether the components, if they are there, actually flow to surface. Because it's largely immaterial if there's plenty of gas there, but it doesn't flow to surface.
Yeah, that's kind of the important bit. You can't sell it, you can't get it. Okay, so let's look at their business model then. So they've got this hypothesis that they can re-enter and find helium, hydrogen, and natural gas. I think we'll maybe talk a little bit later about the markets for those in in Australia, and even I guess how they get it to market. The business model, as explained to me, was that they would be selling it at the wellhead. So between now and being able to do that, clearly a bit of work to do on, can they get it to surface and the economics around that. It's a small company. They've got to spend their money efficiently. How do you see them, building up to the point where they can actually have a conversation around, selling at the wellhead?
Well, I think the first thing they need to do is test the proof of concept. They need to, as I say, quantify the amount that's in the ground, demonstrate that they can lift it to surface. I mean, arguably, it's just molecule moving, so it's no different to lifting oil or gas. It's just a different molecule. They'll use the same technologies. The processing is going to be the interesting part, of course, because you've got helium, which is, bar hydrogen, one of the lightest of gases, and it's a noble gas. So what you've effectively got is something that you're probably going to need to invest a significant amount of money to get the equipment to be able to separate the various fractions. Now, the good thing here is that there's no new technology needed. Cryogenic separation's been around for a very long time, so it is off-the-shelf engineering. It's a question of the size, of the flow rates, and once you've got an understanding of what the field will deliver, you'll triangulate all of those moving parts and start fixing them. So it gives you an idea of what your capital program would be. Now, if, however, it's at in line with their expectations, the size of the accumulation, just from a helium perspective, would probably make it a strategic asset to Australia. And I think at that point, I would imagine that the Australian government would probably want to influence the development and probably do that by playing some part in the consortium that develops the asset base.
Right. Okay. And so in terms of the spend, it's a difficult one to kind of to gauge, because you don't quite know what the one of re-entry is possible, to if it's going to work, etc. But in terms of their proposed expenditure initially, I mean, have they got enough to bank right now to do what they want to do just on Hussar?
Yes, I think so. Certainly, the program that they've outlined, I mean, it assumes that what they've seen at surface and to date and is recorded in the paperwork is accurate. That's always the issue that you have, is that when a well's abandoned and it's not been successful, the concentration level in completing the paperwork tends to fall away, and you only focus on the things that you need to focus on. So there are some hurdles that they're going to have to overcome, but I would be from what I've seen of the program, I'd be quite comfortable that they should be able to meet certainly the re-entry into one of those wells this year, and within the cash resources that they've got available to them.
Right. And what about the team and their experience in doing so? You've got to gain some sort of confidence from what they have done before. Are they equipped? Have they hired the right people to deliver this? Because I'm not even going to get into the economics yet in terms of of all of the gases, but I want to understand: do they know what they're doing? Does the plan make sense, and is it deliverable?
Well, the plan in its broadest sense, makes sense. I mean, the devil's always in the detail, but as with the US market and with the UK market, you don't actually need to have the the individual experts on staff to be able to leverage their expertise. So what they will be doing now is they'll be going out to tender. They'll secure the services of a well management team that will advance the detailed program, cost it up, and then allow them to identify the elements that need to be tendered and the work program and schedules that need to be put in place before it can happen.
Right, and compared to conventional gas extraction, helium and hydrogen, is it pretty much the same? Are there any nuances to it?
Well, I mean, you're talking about much smaller molecules. So, I mean, in essence, no, because you'll always legislate and plan using API and oil field standard approaches and methodologies, because hydrogen is not a gas that is generally found in native form, but it is found quite widely in oil and gas settings. So the management of hydrogen is not unknown. Helium is a more pernicious molecule. It's a lot smaller. It can penetrate through steel over time, of course, but it's inert, so it's non-toxic. It's non-odoured. It's as close to a benign gas as you can possibly get. So as long as you're legislating for the active molecules, if you like, so the explosive molecules like hydrogen and methane, then everything else will just fall into place. There's nothing here that you need to develop. There's no safety protocols that you need to reauthor. They're all standard oil field practice approaches that you'll apply in this exploration program and appraisal program. Sorry.
Okay, so relatively simple work program envisaged here. Now, given there's a kind of big part of this audience who used to investing in natural resources more broadly in terms of mining. This is a very different return profile from mining in terms of speed to market and the speed to cash flow. With something like this, conventional gas, if you're saying it's quite similar to conventional gas, in terms of the time to cash flow, quite frankly, selling at the wellhead, would look like what? Do you think they've been realistic with their timings or assumptions around timings?
Yeah, I mean, I think so. I think, there are many, many different ways in which you can approach a development like this. My guess is that if there's not going to be a wholesale development in this kind of scale that you would see with an IOC, for example, you're far more likely to get a piecemeal approach that approaches it in a modular fashion. You will have to, without doubt, get a better understanding of the reservoir. There'll probably be at least another 2 or 3 appraisal wells on a structure that's potentially this large. Having any less than 2 or 3 appraisal wells just doesn't make any sense. But I think once you've done the difficult part of proving that that the helium that has been identified is movable, I think raising the funds for the next 2 or 3 appraisal wells will be done at a much higher level and would be relatively easy to do. And because you'll approach it in a piecemeal fashion, your FDP that you'll have to submit for approval will be much smaller in scope, therefore much easier to deliver. And I think it's entirely feasible that with a fair wind, that you could get a meaningful development well underway by 2029, 2030. And if you have a more modular approach than that, and of course it depends on what you can agree with the regulator, you could even sell at wellhead very early, maybe even some measure of the test production. I think we're being quite fanciful there, but I have seen strategic imperative drive a mixed gas production facility that looks to ship compressed gas to a treatment station. So you're selling a raw mixed gas that is comprised of a number of components, but it's still revenue. Remains to be seen in this case, and I think it's going to be an interesting program that they've got over the next 6-12 months. And if they do sell a mixed gas in the next 12 to 18 months, well, I think that's a luxury problem to have.
Yeah, well, let's see how they view that kind of commercial and imperative state of the markets, etc., and maybe how they view the different types of revenue stream potentials. Can we just, for those clever folk listening, watching, reading about this, who might want to start trying to guesstimate what the economics could look like, get a sense of this, can you talk about sort of how production rates, or should I say any production declines, work with this sort of project?
Well, that will very much depend on the well design. You can, if you've got a prolific reservoir with high porosity and high permeability, then you're going to get high initial production rates. If you've got strong aquifer support for your reservoir, then you can see those prolific rates being maintained for over an extended period of time. If, however, you've got mixed porosity and permeability, or you've got thin interbedded sandstones between sealing shale layers, for example, then you're going to get a significant edge effect from the migration, or as the gas passes through the reservoir, and you're going to see an initial flush of production come off quite quickly. It really is. It's difficult to guesstimate without seeing any test data how a well will perform. And then once you've got that test data, the reintegration of that data with a well design will then tell you how it will perform for a specific configuration, because it may well be that you can overcome a lot of issues by putting in long horizontals with multi-stage fracs, for example. So it just depends, and it all is really dependent on the outcome of that testing program. We, on the other hand, have been quite conservative and really treated everything as a drainage area with a vertical well with high initial flush production declining at between 20 and 45% per annum. We've really just taken a conventional completion, so reasonably low cost for the depth of drilling that they're going to have to get to. But again, from on the basis that you've got to start somewhere, that's been our starting point.
Okay. And just so you've taken a really reasonably conservative approach to some of the aspects of this technically, but I think your target's 124 pence.
Yep.
So a lot of upside if they get this right. You're suggesting. Let's look at the Aussie component here, right? You've mentioned obviously the potential for this to be classified as a strategic resource, in which case the Australian government may sort of step in some way, shape, or form as part of a JV, etc. So there is that. But what are the red flags? What are the things like let's say Hussar, obviously Western Australia, it's out there. It's a ways from Perth. It's a ways from major towns and stuff. How much of a problem is that for a project like this?
Well, I think this is all going to be about how you develop this asset. It may well be that you provide a collecting station and you ship it as a raw mixed gas to a different area to process it so that you can inject it into the regional hubs. Helium is always going to be shipped by specialist bullet trailer. That goes without saying. It's just a question of how far you ship it. I mean, this is the thing that really differentiates any ordinary oil and gas project from a helium project, is the quantum of the per unit price that you will achieve, even at wellhead, is 2 orders of magnitude greater than you would achieve for gas. We're assuming that a wellhead price for gas will be between about $2.80 and $3. For helium, we're being very conservative, and we've assumed that the Australian government will regulate the pricing. You're talking about $200. You're talking, our base case assumes $270 US dollars per 1,000 cubic feet. So you've got 2 orders of magnitude difference. Now, what that means is that it lowers your barrier to commerciality significantly. And when you're talking about such large structures with such high concentrations, you're talking in some instances maybe up to 8-9%. Quite frankly, you could probably have inerts for the remainder of the gas anyway, and it's still going to make money. The fact that it's also hydrogen and natural gas is a significant positive, because it's just yet another revenue stream.
Right. So okay. I guess the company's going to be clear about the model that they want to employ. There's also some assumptions that you've made in terms of the pricing in the market, and you've got to kind of reach out, because it's a very nascent space. There's not a lot of players. I guess it's it's a high, potentially a very high margin product, but not a lot known about it. I think investors will look at it as a sort of slightly esoteric commodity they can't find much information on. So they're going to make some assumptions themselves. For you, where do you get the confidence from that, one, there's a market, and two, that these guys can access that market?
Helium is used in actually a surprisingly large number of applications. I think the most direct application that people will have seen is, of course, the party balloons. That's always something that people can see, and you'll often, there'll always be somebody in the room that'll get the helium, they'll put it into they'll inhale it, and then they'll speak, and it'll be like Mickey Mouse. That's the most direct, and if you like, the most the most experienced interaction with helium. You also have a significant demand for helium for diving, for making rarefied atmospheres, for deep compression diving. But by far and away, the most significant and direct way in which helium is used is in the manufacture of semiconductors, and also the supercooling of instruments for medical devices. MRIs, for example, use helium every time they're used to enable the detectors to be able to pick up the fluctuations in the polarity of the hydrogen molecules in the body. You need to have exceptionally sensitive equipment, and to do that, it needs to be super cool.
So and then I guess the last bit was, how do these guys insert themselves into that market? Is it a case of waiting for, if the Australian government wants to get involved, because most people are net importers of helium, or would they look to, in terms of part of the financing, create some strategic partnerships now? What's the smartest thing that they could do?
Well, I mean, being blunt, if we say that the Australian government doesn't take a a regressive view and suppresses the helium price. And we say it just takes the price as at disclosed by the helium reserve in the US. You'll see that 275 price jumped to $400 a thousand cubic feet overnight. But if the Australian government turns around and says, actually, this is a private enterprise, we're not going to step in and regulate the market. It's going to be open market, and it's going to be open bid and open outcry. Well, then you can see prices being pushed towards $1,200, $1,500 per thousand cubic feet. So that's 3 orders of magnitude, not just your 2.5 orders of magnitude, your 3 orders of magnitude. And Australia, based on data that's in the public domain from the US, Australia has already paid $1,200 per thousand cubic feet for a cargo earlier this year. So it's not a fictitious price. It's actually an observable price in the market today. So against that backdrop, the 125p or the 124p, that 123p, that we've highlighted could actually see it maybe another factor of 10 and still be reasonably undervalued as a deliverable project. Because don't forget, we've also adjusted the value so that we can account for things like the route to market, the pricing issues, and the fact that the subsurface might not be ideal. We've risked everything in this project, probably down to around about 10 to 15% of what we think it could be on an unfettered 100% success case. So what that actually means is that let's assume that the company delivers on their promises as their pre-drill studies suggest. I wouldn't see that this company would be around for very much longer. I think it would be a target for either a venture capitalist or maybe even a strategic takeover by the Australian state. It really does set the hairs running when you've got such a large resource being owned by a relatively small company. I mean, if this resource were in a larger Australian national, say like a Santos or a Woodside, the impact that it would have on the valuation would be significant, don't get me wrong, but it would be diluted by the remainder of its assets. So the remainder of its assets would probably create a shielding effect. When you have an asset this size that has the potential that it has for a small company, everybody would say, well, it needs to raise money through financing. We know that we're going to apply a discount for that, and you'll have other people that will see through the price that they have to pay to take the asset, and just say, well, we can bring the financing. We think that this cash flow net to us is worth a lot more, and taking it off the market is the right thing for us to do.
Okay, so in terms of your discounting process that you've been through, whether it be your discounted cash flow or technical discounting or whatever did you say P? Are you looking at a P10 on a P10 basis?
We're using a P50.
P50, right? Okay.
We apply a geological chance of success of 15%, roughly, and we've got a technical to commercial chance of success that really net, once you multiply those together, only really see 8 to 10% of the value of the asset reflected in our valuation. That there is huge scope for upside.
Okay. And finally, if you don't, because obviously you've put a lot of work into this. When you finish doing your analysis, when you finish writing your note, there will be some skepticism with people. I think, talk about discounting. I think most people, when they read a consultant or analyst note, that they discount whatever is said there a little bit, right? But when you finished reading this, in terms of your thoughts about the company's ability to deliver this and predicated on being a relatively simple re-entry process, do you actually think that they've got something here?
Yeah, I mean, they've done the desktop work. They've got the access to the license. So on the basis that you're as far as you can go without actually turning the bit, that they've done all they can do. They've done all they've needed to. Now, I think the probably the people that we haven't spoken about are the technical team. John Hugh has been in and around the oil and gas space, the Australian oil and gas space, for a very long time, and there's a lot of inherent knowledge that's within his experience set. So, on the basis that, to use a cooking parlance, you've got a cake, you've iced it, and now the proof is got to be in the eating. There's only so long you can actually look at something before you realize that you actually need to go ahead and do it. You actually need to get you actually need to test what's there to go any further, and that's where they're at right now.
Okay, so if I'm comfortable with risk, this should be appealing. If I'm less so, perhaps they need to wait. But maybe I'd want to. If I'm less comfortable with risk, I might want to wait until they re-enter the well, or are we missing all of the upside if I wait that long?
Well, I mean, I think that's always difficult to say. It depends on people's perception of risk, as you say. And metals and mining has a completely different risk profile to oil and gas, which tends to be a little bit more binary. Either it's there, or and it's commercial, or it isn't. The key thing here for me is if you're happy with the risk that comes with these assets, and don't forget that according to the reports that have been made available, the biggest risk, which is presence, has largely been dealt with to the extent that the reports are saying that there's up to 8% helium been reported and recorded from the gas that's recovered from the well. Then you have to you have to put it in perspective. I never like to act. You can probably tell I never actually like to say people should or shouldn't do it, because it's something that's their own personal perception of risk. But in this instance, there is a set number of hurdles that are going to need to be overcome before commerciality can be declared. And I guess is this a one shot wonder? No. If the first wave of testing proves up the helium, then there's going to need to be a next round of testing. But any funds that are raised will be done at a much higher level, and then you have the re-ask again. What are the risks there? Is there going to be a next level? Well, yes, there probably will be. There may be 2 or 3 stages that need to be gone through before anybody actually says, that's it, it's fully de-risked, and this is where I want to get in. But if you look at where the jumps are in value, the most significant jump that you can take is between resources and reserves. We're on the cusp of the prospective contingent resource area. So a successful test this time round we'll see the biggest single jump that you're likely to see, and then the next steps will be large, but they'll be proportionately less than you've seen previously.
Okay. Well, like Zac, like I say, let's wrap this up. You've kind of got to give us a nice sort of sense of your thoughts on what you've seen, what you've researched on this one. I will take it away and have a good think and a good read, and continue to follow this company with great interest. Appreciate your time today. Thank you.
Good to talk. Thank you.